So let's get started with this video with Meta's, aka Facebook's, earnings. And again, the live stream, I already mentioned this. This was one of the most anticipated ones, and the stock prices just moved in like insanely in the past year. So let's dive into this. Now, we got the earnings summary. They were expecting $1.95 for the EPS normalized estimate. GAAP estimate $1.97 and a revenue of $27.66 billion. 17 total revisions, 16 of them were to the upside. So the earnings came out, and well, it was actually really good. In fact, let me just pull this up right here. And unfortunately, this thing is being stupid. But Meta Platforms GAAP EPS of $2.20 beat by 23 cents, revenue of $28.65 billion. So that was a really good beat overall, which beats by $990 million. I'm so sorry, but this thing just isn't pulling it up. It is what it is. But yeah, it was a beat by almost $1 billion in revenue. And in regards to the EPS gap, it was a beat by 23 cents. So let's come now into their actual earnings report. And you know, we got a statement from our favorite person in the world, Mike. You know who the yeah. We don't like Mark Zuckerberg, but at the end of the day, guys, we're here to make money, and you know, we're just here to make money at the end of the day. So we got, quote, "We had a good quarter of our community our community continues to grow," said Mark Zuckerberg, Meta founder and CEO. Our AI, there it is. AI becomes the new .com. There it is. Another AI kind of thing. Our AI work is driving good results across our apps and business. We're also becoming more efficient so we can build better products faster and put ourselves in a stronger position to deliver our long-term vision. Nice and short and sweet. I mean, you can't ask for more when it comes to that. So
yeah, he just wanted that AI to be engraved.
He really
in your
just
head.
said that just to say AI. You are 100% correct on that. He literally just said that just to say AI. Because, I mean, he probably saw yesterday's Microsoft and Google, and they were like, "Oh, they mentioned AI, and their stock price went up. Ooh, I'm gonna mention AI, even if I have nothing else to say. I want to mention AI." So let's look at the revenues and compare this to last year. We got revenue of $28.65 billion compared to $27.91 billion. That's an increase of 3%. And by the way, this 2022. I believe it is on the first quarter of 2022. All right, so this is not the whole year. This is just the first quarter of 2022. I think I made that mistake yesterday, but so sorry about that. We got costs and expenses. This went up to $21.4 billion as opposed to $19.4 billion, increase of 10%. Income from operations. This actually came down. It was now $7.23 billion as opposed to $8.5 billion. That is a decrease of 15%. Operating margin went from 31% to 25%. 25% is the 2023. Provisions for income taxes, 1.44, and now it was 1.6. That is an increase of 11%. Effective tax rate, that doesn't really matter. Net income fell 24%, going from 7.5 billion to 5.71 billion. Again, decrease of 24%. So why are they up? You know, like, I get the fact that, you know, okay, they beat, but like, overall, they beat on EPS based off of analyst estimates. At the end of the day, they are down in the net income year over year. So now here's something that we definitely want to take a look at, Mike. When it comes to Facebook, I keep saying Facebook. When it comes to Meta, we got the daily active users. Are you there?
Yep.
Okay, great.
The viewers.
The what?
No, I'm just reading what they were writing. Got
you. So we got family daily active people. DAP. Okay, I love that. DAP was 3.02 billion in. I was about to say $3.02 billion. DAP was 3.02 billion on average for March 2023, an increase of 5% year over year. That's massive. We got family monthly active people. So this is daily. This is monthly. Was 3.81 billion people as of March 31st, increase of another 5%. The fact that this is still getting an increase even after, like, you would think that a company like Meta would just stop growing, yet they're still growing. I mean, 5% isn't a lot, but I mean, Facebook is a massive company to begin with, or Meta is a massive company to begin with. So the fact that they are increasing still active users, both on the monthly and daily, that's still very, very interesting. So at least by 5%. Then we got Facebook daily active users. This is the one that gets people. This was 2.04 billion on average for March 2023, an increase of 4%, another increase. Facebook monthly active users, 2.99 billion as of March 31st, 2023, an increase of 2% year over year. And I think this is the reason why their stock price is up so much, because in every single one of these kinds of metrics, when it comes to their users, everything was in the positive every single time. So I think that pretty much explains that. Now we got over here ad impressions and price per ad. In the first quarter of 2023, ad impressions were delivered across the family apps, increased by 26% year over year, and the average price per ad decreased by 17%. We already saw the revenue, we saw the cost and expenses, and what I would like to see is right here, share repurchases. Actually, I wonder if they also mentioned the free cash flow, because you do see capital expenditures, which is very, very interesting to say the least. But we got share repurchases. We repurchased $9.22 billion of our Class A common stock in the first quarter of 2023. As of March 31st, 2023, we had $41.73 billion available and authorized for share repurchases. Wow, that's insane. So they have a lot more to even buy back if they so wish to do so, because they still have. Well, they had.
Because every time the stock share goes down, they just say, hey, we're going to fire a bunch of people. And of course, you got money to go repurchase shares.
I guess that's one way you could look at it, yeah. Next, we got cash and cash equivalents. Cash and cash equivalents and marketable securities were $37.44 billion as of March 31st, 2023. Long-term debt was $9.92 billion. And headcount, I believe this is the people. Headcount was 77,114 as of March 31st, a decrease of 1% year over year. I think this was the layoffs that they did. Yeah, employees. Yeah, further the employees that we had, further the employees that would be impacted by 2023 layoffs were included in our reported headcounts. So there you go. Yeah, very, very good. Now I wonder if do they not mention free cash flow? I wonder if they mention. Let's see if they mention cash flow. They do not. That's actually very surprising. I thought that they would mention that. Anyways, let's take a look now, guys, at the discounted free cash flow, because, well, guys, this is going to be very, very interesting. This company has gone for a ride, so let's see if this is worth buying at the current price of, actually not 209, but instead 233. So we got the ticker for META, market cap of 537.2 billion and a PE of 22.9. So the PE is slightly above what I would like it at 20, but again, we have plenty of time to buy this company sub 100 just a few months ago. Current price of $209.40. We already saw the stock price. Annual dividends per share. They don't pay out the dividend, so they're strictly a growth company. And we can see that this is actually looking interesting, because 5 years ago, their free cash flow was $23.64 billion. And as of last year's free cash flow, it is $19 billion. So that free cash flow has actually gone down. So very, very concerning. But it may just be an issue of them just increasing CapEx, right? It may just be an issue of increasing CapEx, which we did see over here, if I'm not mistaken. We did see over, where was it? Costs and expenses. We did see that their CapEx did go up. So, you know, it is what it is. So let's come now into the overall fundamentals. We got net income 5 years ago of $22.11 billion to 1 year ago of $23.2 billion. Increase of only a 5%. And again, we have seen the fact that year over year, they did go down in their net income, as we just saw in their earnings report. What would you give this as a grade, Mike?
I'm going to say 65, just because of how it's jagging up and down.
Yeah. But also, take a look at this. A decrease from 5 to 4. 22 to 18.5 billion.
Yep.
So
that's when they had that big, massive earnings hit, remember?
That was, I remember that. Yeah. And then this was during COVID, and then this was after. So, and then this was coming back to reality. So, what do you? So you still think? Oh, how much?
No, 65. And KL said, you guys are like the Terminators of the finance channel.
Dun 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 dun. All right. So, what would you give this as a grade?
65.
65 still. All right. 65, and this is what I'm talking about. I kept hitting 65, and it just does not want to go. We got the free cash flow now. 5 years ago of $15.4 billion to 1 year ago of $19 billion, increase of 24% with an average of $23.64 billion. We can see no decrease here like we saw in the net income 4 years ago, but you still see a massive outlier 2 years ago specifically, and then just the crash even
And
coming.
the 1 year and the 3 are lower, and it's below the average for the 1 year. So I'm almost looking in the 40s.
It's below the average than the 1 year. What do you mean?
Below the 1 year ago is below the average for the overall.
Yes, it is. Yes, it is.
So that's why I'm saying 40, because you're jagged, not trending necessarily with the trend, and you are below the
you're below the overall average, which is not something that you want to see. You want to be above the average as of 1 year ago. You want this thing to be consistently increasing. We got now the revenue 5 years ago of $55.84 billion to 1 year ago of $116.61 billion, increase of 108, essentially 109%. What about this one?
I'm gonna say 85, just because you're consistently increasing. You did have a slight slowdown, not by much, between 2 and 1 year.
Okay. Yeah, I mean, you also had a pretty big jump from 3 to 2 years ago. Again, that kind of could be explainable, but I don't like that massive jump. And again, we're seeing slight dip from 2 to 1 year ago. So yeah, I would argue 85 is pretty good. We got now the total assets minus total liabilities. This one is looking interesting. You can see it has been fairly consistently in the positive, yet the highest peak was 3 years ago, but that's perfectly understandable. That was COVID, right? And then, well, it has come down, at least the following year after COVID, it came down by around $4 billion or so, but then it has slightly come back up by around $1 billion. Average total assets, it is $166 billion. Average liabilities, it is $45 billion. Doing this difference, we get $121.13 billion. What would you give this as a grade?
I'm going to say a 70, just because I don't like how it's plateauing.
You don't like how it's plateauing?
Yeah.
Okay. All right, 70%. Looking now at the cash flow minus the liabilities. Now, this one is a rarity because, sure, as of 1 year ago, this is way low. This is really, really low. But that reason is because of the fact that their cash flow just crashed, right? Their cash flow just crashed. But the reason why I'm saying that this is a rarity is because we actually have an instance where we actually have a positive cash flow minus the liabilities. You rarely see that, and that was 5 years ago. The problem is that was 5 years ago. Aside from that, though, you know, the 1 year ago value is just so low, man. That is just so low. So, I mean, their average is negative $12 billion, but you can see the increase even right here from 4 to 3 to 2 years ago, but that massive collapse 1 year ago. So what would you give this as a grade? This was difficult.
I'm leaning in it. Yeah, because it's just massive decrease.
It is a massive decrease, and it was very, very recent. Very, very recent. So 10%?
Yep.
All right. Shares outstanding, the silent killer when it comes to investing. We got 2.85 billion shares to today of 2.6 billion shares. Decrease on the 5 year of 8.41%. And from the previous year to the current year, that's another massive decrease of 4.63%. You can see very, very consistently decreasing, pretty much consistently decreasing year over year, right? Not even one time did they issue. So what would you put this as a grade?
100.
100?
Yep.
We got the hundo. All right.
Yeah.
Let's put in the hundo. Perfect. The hundo. And lastly, when it comes to cash equivalents, they currently hold $14.7 billion with an average of $15.4 billion. So, looking at these overall grades, guys, we gave the net income a 65%, free cash flow 40%, revenue 85%, assets minus liabilities 70%, cash flow minus liabilities 10%, shares outstanding of 100%, overall grade of 63. This came as a surprise because I don't know where they put this when I did it myself, honestly. I really don't remember. I think it was a little bit higher than this though, but you know, it is what it is. You personally don't think this company is a buy right now. Oh, sorry, based off of their fundamentals, you don't think that this company is worth it? Yeah,
pretty much.
What do you see?
The technicals saying the same thing.
Okay, well, what do you see as the yeah? But the technicals isn't based off of the current price though. Sorry, these fundamentals aren't based off of a current price. So the main problem that I see with this is mainly the net income, and and their cash flows. That's mainly it.
For me, it's
they definitely
actually
gotta fix that.
it's the cash flow because of how they're actually sustaining their revenue right now. What they're doing is they're cutting workers.
Well, revenue
And-
is the bottom line.
Yeah, but the thing is, they're cutting their cost by reducing headcount.
Right.
Eventually, you're going to hit a brick wall of you can't cut any more people because you won't have a company left to run.
Sure,
or anyone left to run your company.
Sure, but I would argue that the people that they're cutting are people that they hired during the pandemic, which people thought were going to go into like the Matrix kind of style. So maybe they're getting rid of all those people. You get me? People that, hey, I don't want to say this, but useless people in the company. You get me?
Hey, fair enough. You're gonna get rid of the rot, but I don't see them. I don't see them providing more value to investors other than through share buybacks, which they're using the money that they cut people.
Well, I wouldn't.
For.
You don't know that for certain, but you can make the assumption that yeah, they probably are. All right.
Because
So
what are they going to every time the company falls in price? They just announce new layoffs.
That's
kind of.
That's a fair point. So now let's come over here and make some assumptions. So not inputting anything, guys, with a rate of return of 10%. We got $96.61 not adjusting for debt, and then $198.83 adjusting for debt. So this is interesting because well, let me just put everybody's 52-week range again. $88.09 as of November of 2022. So just looking at this, if you bought at around November, yeah, you probably bought at a pretty good price at that point, right?
Yep.
But let's see what kind of numbers you would give this. So looking at the forward revenue in regards to Meta and Seeking Alpha, we can see that the forwards estimated at 4.88. So what would you give this? And let me bring back up this and the earnings report, and we can see that the change year over year here is 3%. So we got 3% over here as well as 5% over here. So what would you give this as? Like, tell me some revenue percentages.
357.
3, if my computer were to actually work with me. 3, I don't know why this just started happening like today. 3, what is it? 3, let's see. 5, not 56, 5 and 7. All right. And now for the predicted share buyback. What you got?
So they were averaging what, like 4% for the share buyback.
So for the predicted share buyback, they were doing 8% on the 5-year, 8.5% roughly, and then 4.63% and 5% from just 1 year. So what would you give this?
I think 4, 6, and 8.
4, 6, and 8. All right, 4, 6, and 8. Beautiful. So with this, guys, now we get the target share prices not adjusting for debt of $111.87 to $133.80. Just looking at this, you would think that, well, this is not a buy because we're definitely higher. However, target share prices after debt $229 to $273. Again, the price has gone up post-market. It's up to $134.05. So with this $134, I mean, we're still lower than the median assumption adjusting for debt. So this is telling me that this might be a pretty good company to buy right now, even after this meteoric rise from the low of $88 or so. Obviously, if you buy at $88, oh my God, you're making so much money right now. Oh my God. If you sell some covered calls on this thing at like 273, if you bought it at 88, you are making so much capital gain on that. It's absolutely insane. So, you know, do with that information as you will. Obviously, it's not financial advice. Every investment is the present value of all future cash flow. So, you know, take his word for it, take my word for it. At the end of the day, we're not telling you guys what to do. Please have all of these calculators and make your own assumptions for yourselves. So, still though, that's interesting that even after that meteoric rise, this is still looking like a buy for a few of the options here, adjusting for debt. So I think that will pretty much do it for this section of the video. So Mike, you want to take it away with your technical analysis?
So looking at Meta, on the daily, you're sitting right in that price action zone and the reversal zone. So it's similar to how Microsoft, we covered this yesterday, that you were sitting in a similar situation, and no matter what Microsoft did today, they couldn't get past that 300 price point. Similar to this, Meta is actually in a worser scenario just because one is a gap up, two in a reversal zone, and three, you're in a price action zone. So all these things combined, and it's a previous area of where you found sellers back here at the April high of last year. Is definitely where people are going to want to get out, and you could easily start coming back and filling that gap. However, you do have the MACD. Once it crosses, you're going to cross over probably along with RSI, start hitting back to the upside, and it has a lot of room to run. So Meta could go sideways for a couple days and then continue higher. And the thing is, if you can get above the swing point of the $236 area, you got this massive, massive legendary gap to fill. So that gap actually comes down from $248 all the way up to about $315. And basically that means price action can move very, very easily through that, especially if you get a big run in the market. I think Meta would continue along with it. However, some concerns that I have is your MACD is making lower highs as price is making higher highs, which, you know, goes back to that whole divergence. And when this thing rips down, it has the tendency to rip down pretty darn hard. Even though it has earnings, Meta is still one of those companies that's propping up the market. I mentioned this in Microsoft, that yes, you can have a company do amazing, but it is not immune to the susceptibility of the market, especially with the carnage that is going on in FRC that we covered in the beginning of the stream. You have a lot of carnage, a lot of fear. You stoke enough fear in the market, no company is immune. Everyone wants to say that they are, but no one is immune, especially these big tech companies. They definitely have that downside risk, along with the weekly basically having this sharp uptrend. You did cross bearish on the weekly, and you're in super overbought territory. Now you're probably in like mega overbought territory that this could easily make a weekly divergence, and you may get up into that 250 region, I would say. But at that point, I'd definitely be looking for a severe pullback, and volume has been dropping off recently. Obviously, you're going to get a nice push on volume this week on the weekly just because it's earnings, natural tendency to do it. But I don't see the continuation because now you're stretching that trend. You're maybe exhausting. And unless the broader market participates along with Meta, then I would not be expecting Meta to continue higher. However, I don't trade Meta every single day. I don't know how it trades. I know it does trade differently than the NASDAQ because I've seen it where it'll be up and NASDAQ be down. However, again, it's a tech company. It's susceptible to that downturn. And the thing is, if you were holding it at, let's say, the 223 level, and you basically spent the last 6 months hoping to break even, you're at break even. You're going to take profit, and you get a bunch of these people wanting to take profit. The person that bought down here at the 168, they want to take profit, and you create a domino effect that could send pretty much a big selling pressure for the stock, probably fill the gap off of earnings. But yet again, it all determines how price is going to act. I definitely think it has more upside, but I am a little concerned at sitting in this price action zone along with the reversal zone. It's just giving me pause for continuation more to the upside, and that would complete that divergence that is forming on the MACD here, which if you draw it to here, you're basically going to hit your head on that and probably head lower. That's what would be my assumption. But then again, the divergence can be broken and we could possibly go higher. And if we go higher, where could we be going? So you break that zone, you're probably coming up into the 250s all the way possibly to the 260s. And if you really want to have a runner target out there, probably the $300 level. That's a psychological level, along with an area that is just psychologically people are going to want to take profit. I don't think it's going to get there in an instant. I think it would take you a pretty good chunk of time to get up there. Like we saw on the 52-week graph, it took you a pretty much, let's see, it took you about 168 days to get to where you are now. So definitely going to take you another probably 100 at least to get up into this area up here. Now, not saying it can't be done, but there's things that are being shown on the chart that are basically going against you. RSI being super overbought, MACD already crossed bearish. Now, could cross back, but probably form a MACD divergence on the weekly, which would basically just, you have the daily, then a summation into the weekly, and possibly the monthly, which gives you that big rip down. And necessarily, I wouldn't be looking to buy Meta at those extended prices. And the other thing is that they're generating their buybacks, in my opinion, through the layoffs that they have. Now, I'm not saying to not cut rot out of a company. I think that's excellent. However, I do think that there is a limitation to how many people you can cut eventually. Now, not saying that's going to happen the next month, not saying it's going to happen in the next couple months, but Meta is eventually going to run out of people to cut. And when it does, then they got to find a different source of income or revenue to generate into the company. So it's just, there's bullishness and there's bearishness. To me, the simplest way you can make the trade is until you break this uptrend that Meta has had from the lows here. I would basically say until this uptrend is broken, then you pretty much have to respect the company. And actually, I'm going to redraw this just for everyone's viewing.
Can you zoom in on that for a second? Yep, just zoom in. Just zoom in.
Let me do this.
So we can make it a little bit better. There we go. That's the way you do it.
So basically, I'm just trying to give you guys a good trend line to go off of. So you did break the trend slightly if you draw this way from the tip to here. However, big push up off of it on the earnings day. Until you violate this trend line, I wouldn't be looking to go bearish on the company, but it's pretty simple. Once you get below a certain level on Meta, which is basically making a lower low, that's when I'd be looking to get out. Until that happens, you have to stay bullish on the company. It's just as simple of a trade as it can make it through that. I do think it has some resistance headwinds coming up into this region, but if you get above the 250 mark, you pretty much have clear skies ahead to 300 and a very easy expansion. And the broader market would have to expand with you, in my opinion, in order to get to those higher prices. Not saying it can't happen, but I think there's a couple hurdles that Meta has to get over before I say that's more likely than maybe downside potential.
All right. So yeah, at the end of the day, guys, when it comes to Meta, I mean, it's a hell of a company, if I do say so myself, right? I mean, the fact that this company just went sub 100 and now it's above 200, man. I remember when the world was ending when it came to Meta. Oh my God, Meta's falling. Oh my God, Meta will never be able to recover. And it recovered. This is what we're probably going to get eventually when you see the entire stock market, like when we actually go into a real bear market for more than a few months, like we did just a few, like we did last year. You're going to see a lot of companies that are going to be massively in the red, massive discounts, and then people are going to be like, it's falling, everything is crashing, stocks are stupid, stocks don't work, and I'm probably going to be, well, we're probably going to be one of those people that's going to be like, buy everything. In fact, there's going to be way too many offers, and we may not even have enough money to buy them all. So yeah, that's just something.
I called dibs on your right kidney. I don't know what you're talking about.
Hey. If you call dibs on my right kidney, I'm calling dibs on your left kidney. So, you know, an eye for an eye.
It's already sold. It's gone.
Then your right one. Then your right one then. You know.
No, I'm on dialysis.
Iron lung. Anyways. Guys, I think that'll pretty much do it for Meta. Thank you for watching. Like if you like, comment, and subscribe. It really does help out with the algorithm on YouTube and of course or Rumble. So with that said, let's head over now into the second company that also had earnings. And Mike, this is one of your favorites. You know which one it is, right? Lord. We are going to go into now. So yeah, we got, guys, the company now Boeing. And let's take a look if this company is a buy at the current moment. So we got the earnings. Earnings on April 26th. Negative $1.27. Miss. In the negatives, the earnings per share, EPS, were in the negatives already, and it still missed by 22 cents. EPS gap of 69 cents, missed by another 29 cents. Revenue actual of 17.3 billion. Sorry, $18 billion essentially, which is a beat by $360.03 million. So yeah, well, looking at the graph so far, guys, we can see that they're actually up on this, 0.53% post-market and 0.42. Now, when they actually had earnings, It was actually before market open, so this intraday was including the earnings as well. And if you take a look at this beat, if we can actually come down here, maybe if we can actually find it, if they have it. Apparently they do not have it, which is kind of weird. Usually Seeking Alpha is pretty good in having like they beat by this much or they beat by this much. Interesting to say the least. Nonetheless though, the fact that their stock price is up even after the earnings came out with a miss, that's very, very interesting to say the least. Now let's come now into the actual earnings report. And I'm going to zoom in for you guys on this so that way everybody can see. We got Boeing reports first quarter results. Still expected to deliver 400 to 450 737 airplanes in 2023. Plan to increase production to 38 per month later this year. Revenue increased to $17.9 billion, primarily reflecting 130 commercial deliveries. Operating cash flow, you know I love it. When a company puts cash flows right in their highlights, absolutely love it. Operating cash flows of, that's a negative, right?
Correct.
That's a negative. That's so bad. That's so bad. Operating cash flow of negative $0.3 billion. So what is that? $3 million or $300 million, right? Yes, that's $300 million. Yes. That's $300 million. So negative $300 million and free cash flow of negative $0.8 billion of non-GAAP. Cash and marketable securities of $14.8 billion. Total company backlog of $411 billion, including 4,500 commercial airplanes. Reaffirmed guidance of $4.5 to $6.5 billion of operating cash flow and $3 to $5 billion of free cash flow non-GAAP. So they're basically reaffirming, they're like, you know what? We still have the exact same thing, guys. The guidance is staying the same. It is what it is. Like, we're not changing this. So that might be the reason why they actually went up, honestly, because they're not giving negative guidance, but they're not giving positive guidance either. I guess neutral guidance is, in a way, positive guidance. So looking at the summary for the financial results, we got the revenue, let's just say $14 billion in 2022, in the first quarter of 2022, to almost $18 billion in Q1 of 2023, increase of 28%. Not bad. Not bad when it comes to that revenue increase, right?
No.
Increase of what, $4 billion? Not bad. Now, loss from operation. I love how everything just says loss. Look at loss, net loss, loss per share. Wow. We got the GAAP ones now. Loss from operations. You know what? It was a loss, but it actually went up, so it's not that bad. Negative $1.16 billion in 2022 to negative negative $149 million in 2023. Okay. Operating margin went from negative 8.3 to 0.8. Net loss negative 1.24 billion to negative 425 million. Not bad. Loss per share negative $2.06 as opposed to negative 69 cents. Operating cash flow negative 3.2 billion in the Q1 of 2022, and now negative 318. So this is a case where it's like it's negative, but they're heading in the right direction. You get me?
Yep.
So yeah, it's interesting. It's interesting. It's interesting. It's very, very interesting. So let's take a look at what the CEO had to say. Quote, "We delivered a solid first quarter and are focused on driving stability for our customers," said Dave Calhoun, Boeing President and Chief Executive Officer. Quote, "We are progressing through recent supply chains disruptions, but remain confident in the goals we set for this year. As well as for the long term. Demand is strong across key markets, and we are growing investments to advance our development programs and innovate strategic capabilities for our customers and for our future." So pretty much nothing. They're pretty much saying nothing. Interesting to say the least, though. I mean, you know what? At least he's positive, right? At least he's not positive.
I'm like, he's not giving them any bad news. He's just kind of being like, hey, here's what we said we were gonna do. We're doing it. Yeah, everything looks pretty good.
Yeah, that's pretty much it. So, yeah, I mean, let's actually take a look now at table 2 though, because this one's interesting. Here we got the free cash flow, negative 3.56 or negative 3.57 billion dollars in the first quarter of 2022, to now negative 786. Again, even though this is down, this is in the negatives, it's still heading in the right direction. You got to give them credit for that, at least.
Oh, yeah.
Right? You got to give them credit for that. Now, are they buying back shares? That's my personal question when it comes to this, and I'm not fully sure. So, I am going to look this up right now, if my computer permits me. Let's see. So, we got no, there's nothing when it comes to repurchases. Great. So that's pretty much when it comes to a quick overview of their earnings report. Again, guys, all of this will be linked in the description below. So let's come into the discounted free cash flow, shall we? We got the ticker symbol for BA, market cap of $121.65 billion, and a PE of NA. What does this mean, Mike? You've done this for a while now, or do you not know what this means yet?
They have negative earnings.
They have negative earnings. There you go. There you go. Yeah, yeah. Usually, because of the fact that they have negative earnings, you know, their PE is an A. Right then and there, this is a major red flag. Right off the bat. Current share price of $203.03. Obviously, we did take a look at their price, and you know, the fact that they gave pretty neutral, they gave a pretty neutral stance. Not surprised that this is, you know, up 0.42, right, and 0.43 post-market. I kind of see that, honestly. I do kind of see that. Now, this graph, guys, this graph is absolutely crazy. On the 1 year, they're up 21.55%. Year to date, 4%. Now, y'all want to see something insane? Look at this on the 5 year. Look at this on the 5 year. Now, look at this drop that happened right here on February 22nd. Boom. From February 22nd, remember, COVID started to happen in like the end of March, so right around here. So it's kind of ironic that when COVID essentially started to happen at around like the latter end of March is when they actually started to jump up, which is ridiculous, insane. So this drop right here that originally happened was because of the 737 Max that just went down, right? That's the reason why. And you can see that they have not recovered ever since. I mean, they were as high as $440 just prior to the big fall in 2019. In fact, this 52-week range, it is $113.02 to $221.33. So it's just flat. It's been flat ever since that massive drop. Coming back into the calculator, they do not pay out the dividend, as I said. However, guys, we can take a look at their dividend history. So let's take a look at that right now. As you can see, they do not pay out the dividend, but look at this. Dividend history. Boom, right then and there. Look at that. As of February 12th, 2020, they paid out $2.06, and then they just cut it. And they have not reinstated it since, and I do not plan for them to reinstate it ever again. And again, the quick story was that I almost bought into this company back in 2019. However, that's when essentially all the nonsense started. Not when all the nonsense started to happen, but that's when the whole 737 Max started to happen. Back in like, I would say at around like, what was it, like November, I would think? November 2019, maybe December 2019. And that pretty much stopped me from buying it, and thank God that I did. So now looking at these free cash flows, they are really bad. So as of the 5 year average free cash flow, they're at negative $3.65 billion. And as of the last year's cash flow is even lower than the average at negative $6.157 billion. Guys, that's really, really bad. Like, that's really, really bad. They're consistently decreasing. And looking now at their fundamentals, what do you think of this graph? What do you think of this graph, Mike?
Well, it don't take a genius to tell you that's absolute crap.
What? No, it's not that bad. We got 5 years ago of $10.46 billion to 1 year ago of negative $5 billion. That is a decrease of 147%. Yeah, it's bad. It's bad. The lowest point was 3 years ago. You would think COVID. No, it actually wasn't COVID. I mean, maybe it was. I'm not saying that it wasn't. But let's face it. They had problems even before COVID that caused this thing to go down to begin with. So I already said that enough.
We'll give them a 5. We won't give them a 0. We'll give them a 5. Because 5%. They're starting to turn it around slightly.
Well, they're starting to turn it around. Remember, in the quarter, we still have 3 more to go, so
it's a pity 5.
It's a pity 5. All right. Looking at the free cash flow, we got 5 years ago of $8.74 billion to 1 year ago of negative. I really wish I could see beyond 5 years ago. Maybe one day I'll have Seeking Alpha Premium, but yeah. 1 year ago of negative $6.16 billion. That is a decrease of 170% with an average of negative 3.65. Okay, the fact that their 1 year ago is lower than the average, that's a big concern. That's a really big concern. And look at this. They're even lower than as of 2 years ago as well. So, 5?
Yep.
A 5? Okay, a pity 5 apparently. You don't want to give anybody a 0. We got the revenue. Oh god, we got now the revenue 5 years ago of 101. I love this. $101.13 billion to 1 year ago of $66.61 billion, decrease of 34.13%. I mean, the lowest point was 3 years ago, but ever since then they have been consistently increasing. I'll give them that. That's very, very consistent increasing from 3 to 2 to 1. But looking at the overall scale, it's like, oh, that's bad. But then again, their earnings report did say, or at least just indicating that they are on track with their guidance. This is going good, heading in the right direction. We'll see where it ends. So what would you give this as a grade?
Let's see. You're heading in the right direction. You haven't proven, so I'm going to give 50% just because
50%.
You're showing 3 years of increasing after a downturn. So. Yep.
All right, cool. 50%. Total assets minus total liabilities. I mean, so far we haven't seen any of them in the negatives. This is the first one, right? I believe this is the first one we've seen assets minus liabilities being in the negatives, Mike.
Yeah. Pretty much.
1 year. 1 year they were in the positive, and that was the 1 year that it was just up and everything. So 410 million, not even billion, million 5 years ago, and then it just, I mean, yeah, it's just bad. It's just bad. In fact, 2 years ago, 1 year ago is lower than the 2 year ago. So, and it gets even worse with the averages. We got average total assets of $139.7 billion. Average liabilities, it is $154.3 billion. Doing this difference, we get a negative average. A negative average to assets minus liabilities of negative $14.58 billion. Grade?
0.
Okay, so this one you're giving a 0 for. This one you're giving a 0 for. All right, yeah, I think this is deserving. Now you saw the cash flow. Let me just bring up the cash flow once again. You saw the cash flow. What do you think happens when you mix negative cash flow and a liability?
A bigger liability?
Well, you get this.
Ouch.
You get this thing. It's so bad. We got. I mean. Okay, I'll give them credit on something. Their lowest point was 3 years ago at negative $183.4 billion. That's crazy. But look at this. They have gone up a little bit from negative 183 to negative 158.58. But then they're a little bit lower as of 1 year ago to negative 159. And that's still lower than the average of negative $150.74 billion. So, great.
0.
See, now you're being too harsh. I would actually give this a 5, mainly because you saw one increase. You saw just one increase. So, but I'll follow. I mean, it's either a 5 or it's a 5 really gonna make a difference. Like, not really.
2.5. We'll meet in the middle.
Dude, no. I'll give it a 0. I'll give it a 0. I'm taking this from somebody who doesn't know. Who doesn't do the fundamental side. So I actually like it, the fact that you're giving me the numbers that you're giving me, and I'm trying not to persuade you as much as possible. Now, what was that?
Unless you veto me.
Unless I veto you, yeah. Unless you're just like completely off your rocker. Looking at the shares outstanding, well, one time they decreased it. We got 5 years ago of 567.6 million shares to today of 597.6 million shares, increase of 5.3% on the 5 year, and another increase of 1.5% from the previous year to the current year. This is looking at 2 years ago of 588.9 million shares to 1 year ago of 597.6 million shares. Now, it's not a consistent increase. Now, I get it from 3 to essentially today. It is a very consistent increase. But they did bring it down by like $5 million from 5 to 4. Or, sorry, not $5 million. 5 million shares from 5 to 4. Great.
20%.
20?
Yeah,
really?
Because what would you give it? Because like, it's
remember, shares outstanding. It is, you don't want a company to be issuing shares because that's diluting you as the investor. But at the same time, it's like, Maybe they're just doing that to raise capital. They needed to raise capital one way or another, right?
Fair.
But at the same time, though, 5.29% over the past 5 years is not a lot, especially with all the problems that they have been having. So you said 20%?
Let's do 50. We'll give them the benefit of the doubt in the middle, where it's not too crazy, but it's not, because like you said, they're not diluting you a lot, but they are diluting you, but also they're trying to fix the business, and you're starting to see that kind of come to light now.
Okay. Yeah, okay. I could see that. Yep. I was about to like veto it, but after you said that convinced me. And looking now at the cash and equivalents, they currently hold $14.6 billion with an average of $10.4 billion. Looking at the overall grades, I mean, for God's sakes, we gave the net income and the free cash flow of 5%. This is not going to be good. We gave the net income of 5%, free cash flow 5%, revenue 50%, assets minus liability 0%, cash flow minus liability 0%, and shares outstanding of 50%. Overall grade of 20%. So, what do you think is the biggest problems when it comes to this company?
Cash flow.
Cash flow, pretty much just the profit
and
metrics.
their liabilities.
Yeah.
Now, then again, because they do a lot of government stuff, I really would have to see how they compare to like Lockheed Martin, Raytheon, all those companies, their liabilities and structure, because it could be a sector thing, similar to how.
No, I'm telling you right now that I've done Lockheed Martin, and no, it's not. So yeah,
like I said, I don't trade the sector, so I don't know.
Yeah, the industrial sector. I love the industrial sector, but that's just me. All right, so 20%. Now let's see if the current share price, this is a buy. Are you ready for this? Oh boy. Yeah, I'm actually kind of liking the fact that we haven't done companies with a dividend so far. So, huh?
That's shocking. $100 per share.
$100 per share. But look at this. Adjusting for debt comes down because they have a ton of debt in comparison to their cash and equivalents.
Okay.
So now adjusting for debt, $105, let's say $106, and then adjusting for debt, $61.14. Now, let me bring this up again. $113, guys, at the lowest point, 52 weeks. That was at around September 20, actually no, it was, wait, when was that? Oh, it was at around June. So it was about a year, almost a year ago. June 13th, 2022, it was essentially when this calculator is saying that's a goodbye. So let's input some numbers. Are you ready for this?
Yep.
Seeking Alpha is saying that the forward revenue is going to be 13.5%. And yes, this is Boeing. So, 13.5% is estimated for the forward. And again, let's go back to this earnings report. The revenues grew 28% from Q1 of 2022 to Q1 of 2023. So you got 28% over here, and overall 13.5%. So it's very bullish when it comes to these revenue growth assumptions, at least on the analyst side.
Especially if they're turning the company around. I'm gonna go a little low on the low assumption, just so we have a good range.
That's fine. Yep. How much?
10.
10? I thought you said low.
Well, you'll see what I mean. 20.
Oh my 30. God, you're going 10, 20, 30. Dear Lord. Okay. So you're basically saying that in the next 5 years, they're going to continue to increase this revenue that they did in just from Q1 of 2022 to Q1 of 2023. They're going to do this consistently year over year for the next 5 years.
They have the I think, like Boeing.
I'm not saying anything. Listen, I'm not saying anything. I'm just saying
they have the capability to do it. I don't think. Well, over the next 5 years.
For the next 5 years, cumulative. So this is 30% cumulative. So this is not 30% every year. This is 30% in the next, like total 5 years.
I think they can do it. They did it in 1 year. So theoretically, if they continue going across 5 years, then they can accumulate that. Okay,
fair enough. Now for the projected share buyback, they've been consistently issuing. And if you want me to bring that number back up again, I should really have that number like over there so I don't have to reference it. It is at 5.3% on the 5 year and 1.5% from the previous year to the current year. What was it?
246.
246.
They're going to issue 2%, 4%, and 6%.
So
because
negative 6. So negative 6. Remember, this is issuing, so it goes from lowest negative to highest negative. So negative 6, negative 4. And what was it? -2?
Yep.
Okay, -2. Perfect.
So I think they're, in order to get the revenue growth, they're going to have to raise some capital, and that's probably the thing they'll turn to.
Yeah, I agree with that. And well, this is interesting because guys, not adjusting for debt, this is $141 to $272.64. Adjusting for debt, this comes down a lot to $98.82 to $228.28. Sorry, $228.77. With a margin of safety of 5, 10, and 15. This is between $84 to $217. Now, the current share price is $203. I mean, let's face it, it is what, 204 post market. So we are, I mean, we're falling right here. The highest assumptions. The problem is that that's the highest assumption. That's scary. You get me? Like that to me isn't a really good safe investment thing. Like if it were to fall between like the median and like the low, I'll be like, okay, this is looking very good. But the high one, especially since it's going up by 10% on the revenue, I'm not sure if I'm comfortable buying this company at the current price of 203, even though it's telling me that 272, not adjusting for debt, and then 228. Right,
but like your high assumption, we purposely made it as a stretch goal. We kind of basically said, here's your kind of rosy picture, and then the best realistic scenario, like you're saying, is going to be between the median and the low. Right.
So, I mean, it's interesting. It's interesting because, yeah, based off of your assumptions, not even mine. Yeah, this is very interesting. Now, what I would have given it, maybe this is something that we should do. Maybe we should do like one for you and then one for me.
Okay.
Yeah, I think we might do that like next time we do like a big stream of live streams. I'll probably add that to it should be fun. What I would personally do, I would keep the 10. I would have put 13, and then I would have put 16. That's what I would have put. So if we were to do that, now let's give you guys another perspective, shall we? I would have kept the shares outstanding the same, honestly. So that was a 10, 13, and 16, right?
Yep.
Yeah, that would be $141 to $178, and then $98.82 to $134.43. So, yeah, it's interesting, right? It's interesting how much just a few what is that? 14 percentage points changes overall. Yeah. Yeah. So again, guys, not financial advice. Every investment is the present value of all future cash flow. You just saw I put in what he told me, different numbers than what I just put in, right? Completely different types of target share prices. So all of these numbers can change. And when it comes to Boeing, it's a company that you really need to take a look at not just their earnings report, which will be linked in the description below. Please read it for yourselves. We go over them very, very slightly, but you guys need to read it. Also go over their 10Ks, and not just from 1 year. Do it for like 2022, or sorry, do it for like 2021, 2020, etc. Because this company is a problem. Now, they have benefits in the sense that they are a duopoly, but that doesn't mean anything, right? That doesn't mean anything. So, yeah, very, very interesting to say the least. Overall, though, I personally, I'm just not a fan of Boeing. Not at the current state. It just isn't. So, with that said, let's jump over now into the technical analysis with Mike.
If you look at where you have a lot of conglomeration of price zones, it's sitting between that 120 and that $100 region, which, as you notice, there's been a lot of buying pressure in that area and creating a lot of structure of where you're going to have Boeing want to go upwards on it. So that's going to be an interesting thing. Also, you have a monthly sell zone that's sitting right where you are now, price sell zone trend being bearish. You're literally just kind of saying, hey, I want to maybe lose money if I buy up here. I do think Boeing had this meteoric rise. It had a W on the daily. So if you guys can't see the W, I'll draw it out for you. W right here, punched up, but once it got above here, it kind of been stagnating very much so. We're actually going to go to the weekly to show it a little bit better. So you have this coil winding up, and I was actually drawing a coil right here where it kind of broke to the downside, but it's forming a bigger coil. Where can this go? It can break to the upside with the MACD showing, and it can also break to the downside with the RSI showing. So for me, if it breaks to the upside, I'm basically targeting that $250 to the $234 region, which is these two price zones. based on the most recent earnings and how the market's evolving, I'm leaning more towards the downside. But on the monthly, I do see the potential. Keyword potential doesn't mean it's going to happen. That this MACD continues higher. It's pretty separated from one another right now. I'm going to highlight the areas for you. So basically, you got pretty good separation between that. However, is a monthly candle. You are making monthly inside bar. You made a higher high on the previous month, but you are closing inside the bar, or looking like you're going to close on the inside of the bar of the candle. So basically, you stopped going up, now you're going sideways. What do we know about the market? Market went up, stopped going up, went sideways, and now it's kind of downtrending. So similar things to here. You're stagnating in this area, and where could you be coming back down to? And for me, it's going to be as pretty simple as I can, and where I'd be looking for like that. This is where I'd be long-term buying Boeing. If I was going to look to buy Boeing, it'd be down in this $105 to this $120 region, somewhere in here, depending on where price could find. You could find a double bottom around 120, which would match the median assumption you got, where basically we were saying that's the median assumption, and then the low assumption was down in the 80s, which coincidentally would put you probably down in this monthly reversal zone that would be like the go sell a kidney type buying point, because Boeing hasn't been here since 2011. But if we look at the weekly, just to get more refined picture on it, your 100 is basically the weekly reversal zone, and you have a price action zone saying 127. So somewhere in that sub 120 area to 100 is where I'd be looking to buy, especially the RSI. Once on the weekly bottoms out oversold, that's where I'd be looking to pick up Boeing. And you got some resistances up here, like we mentioned before. Starting resistance 226, middle to 33, and then the upper is probably the 240, banging your head into that reversal zone, and middle of that selling target. So I do think you have the capability to go up higher, especially if this coil unwinds. But you also have that same potential to the downside. And if it starts ripping to the downside, starts breaking some of the structure, especially if it breaks 173, I definitely think it would self-fulfill, breaking this W structure, coming back down to the $127 region around there. That's where I'd be looking at maybe buying opportunities on Boeing. Remember, it doesn't pay a dividend, so you don't have the safety of the dividend. But as you can see here on the daily, you just have a bunch of price structure. And this is what I was saying, like your MACD is already looking like it wants to go higher. However, you could go easily higher, continuing to build this coil, bang your head into the $217 region, then come bang your head at the 195. So Boeing's just been going sideways like no tomorrow, and there's been a lot of accumulation in the zone, and when it breaks out, it's going to break out violently. And can I tell you which way it's going to go? I have absolutely no idea. I see on the daily, there's definitely upside potential in the short term, but just looking at the overall market, I say more downside potential. But until it breaks, basically, I'm going to say the 220 region or sub 192. I'm going to say 190 just to be safe on the downside potential. I would say that we don't have a more price discovery anywhere else. It could go sideways for months. That's also, especially being Boeing classified as a recession defensive stock. That's what it's traditionally known as, especially in industrials. You could see sector rotation into it, which props the upside, but also if you get a recession fears, then there's so many questions around it, and especially where it is now, it's basically an unstable place to buy, in my opinion, just because you have that coil. That coil is going to punch someone in the face. And like Mike Tyson says, everyone has a plan to get punched in the face. What are you going to do then? I'd rather just prefer not to get punched in the face, not trade the company until it makes a decision, and then I basically ride the trend. Trend is your friend to the end, and it's simpler then. Why are you trying to guess the trend when you can just wait, ride the trend, and make money going that way? It's as simple as I can make it there, and you got the levels that you need to break up or down. But as of now, because you got different things, like I see the potential on the daily and the weekly, but I also see the potential for the monthly to start crawling back down if I see price action going a different way, especially with all these price zones just banging your head around here. And remember, Boeing had a big sell-off. If we go back to these peaks here, you're going to have price structure that you're going to keep hitting. And that's why I think this W stopped, because you hit this peak right here and basically couldn't get it back above the 220 area, and basically you've been failing to get above 220. I definitely think you could price discover higher. However, it's a very bumpy uphill battle for me. If I really wanted to hold Boeing, I would like to see that push down, accumulate there, and then build up as it goes and dollar cost average in on the way up once it finds that true bottom. And you guys know our theory about the market. I don't think the bottom's in. We never found a bottom in the market in a tightening cycle. So take that whatever way you want. I'm going to be looking for Boeing at that $115 region. That's going to be my prime price target for it. And then use the calculator and whatever levels we gave you today to kind of decide where you find value in the company. Just make sure you have a plan. Have a plan. Have a point where you're going to stop out and just execute the plan. That's as simple as I can make it.
Awesome. And yeah, man, at least when it comes to Boeing, I don't know. I just have some terrible stuff when it comes to Boeing. I don't like it. So
well,
it is what it is.
The technicals are telling you someone's going to get hammered to the face.
Yeah.
Do you want to participate in the hammer game? You got a 50-50 shot.
Yeah.
Or I can just let the other guy get smacked with the hammer, and then I'm just going to go in the opposite direction.
Right, exactly. So with me, I'm personally steering away when it comes to Boeing, but if anybody wants to go at it, then by all means go at it. But for me, yeah, it's definitely not a buy at the current moment. But anyways, yeah, guys, that pretty much does it for the stock analysis / the technical analysis when it comes to Boeing. And if you like, comment, subscribe. It really does help over the algorithm on YouTube. You guys can follow us on YouTube sites. Link is in the description below. So with that said, let's move now into the last company that I want to do. Want to take a look at the earnings report and that is the company Roku. It's one of those companies that's like, it's a growth company. It's a straight up a growth company. You're going to see it, especially with those shares outstanding. When you look at those shares outstanding, you're going to be like, what? That's crazy. And also something to note for you, Mike, and for anybody watching. This is, I believe, well, people here on the channel have seen this, but this is, I believe, the first time where you're going to see that discounted free cash flow not working.
Okay.
Because discounted free cash flow works for companies with somewhat consistent profit metrics, consistent, either decreasing or increasing. But what you're about to see with Roku, you're gonna be like, what is that? We're talking like a delta in 1 year of like complete opposites. Like, it's ridiculous. It's absolutely insane. So what you're about to see is going to cause the calculator to actually not work. So instead of using discounted free cash flow, we're going to be using book value per share, because you can use book value per share. So you still got that one. Nonetheless, though, let's get started with Roku's earnings. Now, we can see that their earnings report was estimated at, right then and there, negative. And by the way, this is Roku, right there, Roku Inc. Negative $1.48. $1.48. That is very, very concerning. Same thing for the EPS gap estimate, negative $1.48. And, well, you can see that the revenue estimate, $707.59 million. Not billions, $1 million. And, yeah. What is that? What is that? I can't do math right now. 13 total revisions, 9 of them to the downside.
Yep.
9 of them to the downside. So, let's take a look now at how they actually did when it comes to this. If we come down here, we can see Roku EPS gap. Roku EPS gap of negative $1.38 beats by 10 cents. Revenue $741 million beats by $33.4 million. So not a big beat, right? That's not too much of a big beat. So, yet take a look at their share price. Intraday, by the way, they had earnings after market. Intraday, they were down 2.01%. After market, well, you can see that their earnings pretty much brought them up, but we're still pretty much flat just based off of what they lost on the intraday. So that's very, very interesting to say the least. Now, let's come into their actual earnings report. And this was a pain to find because they have it very, very stupidly made. Or like the way that they have it is just stupid. But we get over here the earnings report, and let's take a look at what I believe this is what the CEO said. It's not in quotes. I'm not fully sure. We delivered solid first quarter results in a challenging macro environment, growing both active accounts and streaming hours year over year. Roku continues to delight viewers and partners with some of the biggest brands and global entertainment companies. With unmatched scale and engagement, we are creating new monetization opportunities to re-accelerate revenue growth as the ad market recovers. Boy, did the ad market just took a hit. We definitely saw that on the YouTube revenue. At the same time, we are managing investments and costs and executing on our plan to deliver positive adjusted EBITDA for full year 2024. So we got over here, guys, their total net revenue of $741 million. That's up 1% year over year. So right then and there, I think that's the reason why they went up. The fact that their revenue did go up at least 1%. Platform revenue was $635 million. That was down 1% year over year. Gross profit was $338 million, down 7% year over year. Active accounts were $71.6 million. A net increase of 1.6 million active accounts for Q4 of 2022. Streaming hours was 21.1 billion. Wow, that's crazy. Up 4.2 billion hours year over year. Average revenue per user was $40.67. On the trailing 12-month basis, it was down 5% year over year. Roku operating system was the #1 selling smart TV OS in the US with 43% TV units share. All right, so what do you think of that?
I think it's a mixed bag. Kind of you're increasing, but your revenue from a year ago is kind of like sideways. Like 1% ain't crazy.
1% is just, for a growth company, that's not that impressive.
Yeah.
Right? For a growth company, that's not that impressive.
It should be double digits.
It should be a zero behind that one. So looking at this, guys, we can see the total revenues. And Q1 of 2022, we got $733.7 million. As opposed to Q1 of 2023, 741. You can see that they... Okay, wait a minute. Yeah, it's dropping, but Q4, though. Q4, that's the holiday season.
Fair enough.
You kind of...
And it's also, if you look on the previous one, it's not as a big drop.
Right. I mean, you're taking a look at 733. So if the trend continues, then this quarter, when we get it in Q3, we should see it around like 780, right? $780 million, right? And then Q4, it should be like in the $1 billion mark. But yeah. When it comes to the total gross profits, we got $365 million and $337. That's a decrease of 7%. All right. That's not good. We got total operating expenses going up from 388.3 to 550. That's up 42%. Do they have... Oh, look at this. They even have the outlook over here. I was looking for the cash flows, but let's actually take a look now at the outlook. We got total net revenue. In Q2 of 2023, $770 million. And what did oh, that's for the revenue. Yeah, so what did I say? What did I say? At around like 780, right?
Yep.
780, and they're expecting what, 770. That's pretty close for not knowing what this number was going to be. Total gross profits, 335 million. Net income loss, so they're expecting a net income loss of 175. And in regards to this, we did not see the income loss though. Right here, the income from operations was a loss of, it went from negative $23.5 million to negative $212.5 million. That's a decrease of 804%. That right there is a pretty good indicator of what you're about to see when it comes to the fundamentals, by the way. So that's what do you think of that 804?
I think it's absolutely insane.
Yeah, it's bad. It's bad. And look at this. They're projecting a net income loss of it's going back up to negative 175, but still that's just bad. That's just really, really bad. And I don't think that there really is anything else I really want to take a look at. This reminds me of the TV I have. But yeah, now let's come into the discounted free cash flow. But as I said, guys, this company does not work with discounted free cash flow. We're just going to use it for the fundamentals, and that's about it. But fortunately, when you guys see the fundamentals, you're going to see exactly what I mean. We got the ticker for ROKU, market cap of $8 billion, a PE of NA. Not surprising because their earnings are in the negatives. Current share price of $56.56. Now, looking at this graph, we can see a massive decline in the 1 year of 38.36, and year to date, it's up almost 40%. That's insane. That's absolutely crazy. And look at this 52-week range though, $38.26 to $110.56, and I don't believe that was even the highest. If I take a look at this in the 5 year, this thing was up to $400.
Yep.
Mike, to anybody that says stocks don't fall, let me zoom in on this. Actually, let me just zoom in on this a little bit, because anybody who says stocks don't fall, give me a break. This thing just went from a whopping $450. $450. People right here at this point were saying to the moon, to 1,000, to 600, to 1,000, to 1,500, and just crash to the ground. Why? You're gonna see why. Because when you take a look at those fundamentals, man, do they show exactly what kind of company this is. Now, the thing is that just because a company is a growth company, that doesn't mean that you pay anything for it. At this point, guys, I don't believe I did this company in 2021, but if I did, I most likely said it's not a buy. It's just not a buy. And well, let's take a look at why. They don't pay out the dividend, so full growth company, obviously they don't. Average free cash flow in the 5 year, 7.22 million. It's in the positive, right? Boeing wasn't in the positive, so this one's in the positive. They at least got that going for them, right? However, last year's free cash flow, negative $150 million. I thought this was a growth company. This isn't the average. Mind you, this is not the average. This right here is not the average. This is the average. So the fact that they're at negative $149.9 million last year in their free cash flow is a major concern. So let's jump into these fundamentals. So net income 5 years ago of negative $8.9 million to 1 year ago of
0. Actually, can we put a negative 100?
No, you can't put a negative. We can't put a negative for a grade. You
0.
can't put a negative for a grade.
If I say anything other than 0, you're gonna veto me and be like, no.
Negative 4. So 1 year ago, so 5 years ago is negative $8.9 million. 1 year ago, negative $498 million. Now that you see why this thing doesn't work, look at what they did, guys, 2 years ago. Positive 242. Okay, yeah, great. After COVID, people are watching TV. Guys, you had 3 consecutive years of negative. A massive spike from negative 17.5 million to 242.4 million. And then just... I don't know what else to tell you. Look at this. Look at that decrease.
Insane.
5,500%. I mean, I really wish I could go negative on this, but no, I cannot. I cannot. So 0%. Free cash flow.
0. We're not even just 0.
It's a little bit better. It's a little bit better than that of the net income, right? 3 years ago it's not negative, but guys, 5 years ago of negative $4.4 million to 1 year ago of,
we're just all over the place.
it's literally, and this is the reason why it doesn't work. You just have boom, 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 boom. It's like it's all over the place. The guys
just pick some random numbers, put it
and
on
just
a
put it,
dartboard, blindfold yourself, and that's what their next year is going to be.
pretty much. So, well, obviously past returns don't mean future returns, but still, well, this is again negative $4.4 million 5 years ago to negative $150 million last year. That is a decrease of 3,307%. But again, the
And
average
they're
being
projecting
7.22. What was that?
And also they were projecting like negative 175.
They didn't show free cash flow though. Yeah, they did not show free cash flow on this. Yeah. They did not show free cash flow. Well, they're projecting
income, I do believe they
they're
did say.
projecting,
Net
yes,
income
they're projecting the net income loss. But remember, this is only for the quarter. This is only for Q2. So,
Okay.
you know, if they're projecting negative 175 over here with an income loss of 212, you got to add the negative 212.5 plus the negative 175, and then that's what you get for half the year. But
Gotcha.
you get me? So the numbers that we're looking at is for the year. So you
Okay.
can't really equate the two. You get me? The earnings just gives you a direction, but yeah, 0%. I fully agree with that statement. Okay. Are you ready for the revenue?
No. And that is interesting.
It's a growth company.
Makes sense.
It's a growth company. Usually growth companies are like that. Their net income, their top line.
Yeah, they don't make any money, but they continually
Their
grow.
top line is good. Their bottom line is awful. So, sorry. No, other way around. Other way around. Sorry. Other way around. The bottom line is good. Their top line is awful. So, yeah. I mean, you got a consistent increase, $742.5 million to 3.13 billion dollars, increase of 321.1%. This is very consistently increasing. What would you give it?
95, just because like you're kind of the trend going, not hugging it completely, just slightly.
I would argue 95 because it's a little bit of a jump from 3 to 2 years ago. That's about it. Yeah, that's really about it. Okay, assets minus liabilities. Not looking too shabby either, right? Consistently increasing. I do not like this massive spike though from 3 to 2 years ago. That's a massive spike. In fact, they're bringing this back down. So we got
60.
average total. What's that?
60.
Hang on. Average total assets, it is $3.33 billion. Average liabilities is $1.3 billion. Doing the difference, we get $2 billion in the positive. Would you get 60? 60?
Yep.
Yeah, I was at 60. Are you getting tired?
A little bit.
A little bit. Listen, we haven't even gotten that much as yesterday. So, all right, looking now at the cash flow minus the liabilities, consistently decreasing year over year. As of 1 year ago, they are at negative $2 billion. This is looking awful. I mean, the average, it doesn't even get to negative $1 billion. So, grade?
Zero.
Pretty much a zero. Yeah. All right, and are you ready for what you're about to say?
Am I gonna gouge my eyes out?
Oh yeah. If you thought that net income and free cash flow was bad, shares outstanding.
And they're issuing shares.
I mean, they have to. Usually, growth companies do. But look at that rate though. We got 109.8 million shares 5 years ago to 140 million shares today. Increase of 27.5% on the 5 year and 3.63% from 1 year to the next year. So again, 2 years ago, 135 to 140. So consistently increasing. What would you think?
Zero.
Understand something as well. Let me point something as well to you. At that point, a couple of years ago, 2 years ago, right? Pretty much anything prior, anything prior to this massive collapse. So 2 years ago, right? Their share price was high. So if they're issuing shares at a whopping $400 and whatever dollars, they're gaining a lot of money.
Oh yeah.
They're probably like, this is not worth 400. Let's issue shares because people apparently will just continue to buy it. So it's kind of I understand why they did. It's not good that they did it though. So,
but you have a trend that you're not seeing a sharp increase from year to year. So even though the share price was going exponential, you still they're just sticking with their business model of
right. And if people keep buying it, they'll keep issuing. It's like the seller to the drug addict, essentially. You know, they just keep buying it. And lastly, when it comes to the cash components, they currently hold $2 billion on an average of $1.31 billion. I mean, this grade's going to be awful. We gave the net income and the free cash flow 0, the revenue of 95, asset minus liability 60%, cash flow minus liability 0, and just net income 0, total grade of 25%. They have problems. Again, this is a growth company. Now, whether you buy it or not, based off the fundamentals, that's one thing. Or whether or not you like the fundamentals is one thing or another, right? It's a growth company. You expect them to be this bad when it comes to the net income and the free cash flow. But now the problem is, what price should we pay for this company? And that's the mistake that a lot of people did buying this company at $450. So that's what we're trying to avoid. And as I mentioned, guys, we can't use this kind of free cash flow. And here is the reason why. Not inputting anything, we are getting insane numbers. We're getting 137, 288. Yeah, it's bad. It's bad overall. Now, do you want to entertain this, or do you just want to go? You want to entertain this?
Yeah, listen. I want to entertain. I want to see it. You know, it's the first time I'm seeing it the way it is. So
okay.
Let's see.
Okay. So we got. Okay. So I'm just gonna let you put in all the numbers then. The growth assumption of Seeking Alpha is 11.21% on revenue.
All right.
Again, this is Roku, and their earnings so far showed a total revenue increase of 1%. So you got 1% when it comes to their earnings report, and essentially analysts are saying 11%.
Yeah.
That's a
Analysts
massive.
also said FRC was a buy, but you know, we're not going to go there.
Fair enough. So what would you give this as a grade?
I'm actually going to say that they could, low assumption is -1. I think that the revenue could start stagnating.
Okay. -1. 0.
Yep. And then
1%. Okay.
Yep.
Yeah. Okay. And now for the big one. This is gonna change a lot. This will change a lot depending on what you put.
So it was what, 30%?
It was like close to 30%. Yeah, it was like 27. It's like 27.
So let's say they dilute you a little more. So let's say 35.
35. Okay.
30 and 25.
Okay. What was it? 20?
No, 30.
30. 30. Okay, 30.
Yep. 30 and 25.
And 25. Well, I mean, adjusting for debt, this is still worth above 200. Not adjusting for debt though, I kind of believe this number more, seeing that it is at $95.23 to $112.06. I see that a lot more, but the problem is that I don't know where their cash flow's going.
Right.
I don't know where their cash flow's going, which is a problem. The revenue is very, very consistent though. Now, based off of that, let's actually use the book value per share, because this one's way more reliable in my personal opinion. Again, book value per share, guys, it is the assets minus the liabilities divided by the current shares outstanding. And based off of the book value per share, this thing should be worth $18.90. This is up 750% from 5 years ago of $2.23. Looking now at the tangible book value, should be worth a little bit less, $15.24. This is up 500, almost 600% from 5 years ago of $2.20. Now, okay, we know the price that the book value is telling us. And if we take a look at the valuations, we could see that, is this actually, oh, I forgot to actually change this. One small second. I forgot to actually make this equal to this one over here. I'm so terribly sorry. I'm like, there's no way that it's cheaper. How can it be cheaper? So based off of the valuations, guys, the price to current book value, it's looking at 2.99, so essentially a ratio of 3. And the price divided by the tangible is almost 4. At value is 1.00. So yeah, it still would need to fall a significant amount for me to actually fall in love with this company, right? It still would need to fall. And to those people who say it can't fall there, it was 450 just 2 years ago. 2 years ago it was $450, and people said at this point it'll never fall. And look at where we are now.
It actually nearly hit 500.
It actually nearly hit 500. Interesting, but yeah, guys.
490 and 76 cents was the peak.
And you're telling, and at that point, I would have said it needs to fall. It's way too expensive, and people would have probably been like, "It'll never fall. It'll go to a 600, 1,000, 1,500. It's a growth company. You don't understand growth." Kathy Wood, I love her. I really do love her, and I'm saying that sarcastically. She's constant. This is one of her biggest holdings, and then you wonder why ARK K, it's like horrendously in the gutter. So I wonder why. Guys, you can overpay for growth, and this is what we're trying to avoid, is overpaying for growth. So unfortunately, if you bought this at the $500 peak, and you're seeing this video and you're like, $18, $15, oh my god, that's so much. I'm sorry to tell you, but you overpay for growth. It is what it is. So that's pretty much all I wanted to cover in regards to the fundamental analysis. What do you think of the company, Mike?
I think it's a hot turd.
Well, okay, I wouldn't go that far, but I mean, I think it's a growth company. It's just I would not pay right now, $56, even after the massive drop. I just still wouldn't. I like it more at around the $20 kind of range, honestly. But yeah, let's move over now into your technical analysis, shall we?
Everyone knows on the channel, I talk about the 200 weekly moving average until I'm blue in the face. And basically, it is where you're at $179. So for me to even consider Roku, it has to get above this moving average, which would probably take a decade to come down and maybe find value. Then again, my problem is that when you have a company that has fallen so much, and then if we look at the weekly, where your basically you are forming a divergence here, and you're heading lower prices, and the MACD is going up. So it's maybe indicating a bottom forming, but just looking at the RSI, it's very close to crossing the 50 mark right here. Expand it for you guys. So it's very close to crossing that 50 mark, which I'm going to make the blue line. It is just very bearish in my opinion. And the thing is, you only have one price action zone sitting here at the $40 mark. So if it comes down here, it breaks this, just waterfalls down. It has the waterfall capability all the way down to 0 just because it has no price structure. And I'm not saying that sarcastically. I mean, there is 0 price structure sub $28 because the IPO of Roku was $26.54. So if you come back below that and create new all-time lows, you don't want to be investing in a company that's creating new all-time lows. Everyone wants to make that argument, but here's the thing. Okay, I'm going to spend the next decade trying to get my money back, or have my money not dissolve or lose it to inflation because the company's going to go sideways. I'm going to lose it to inflation. I don't enjoy that. I don't enjoy doing that. And here's the thing. Yes, your risk or reward may be 1 to 300. Okay, but when does that pan out? When does value actually show up? And to me, value shows up when you get back above this 200 weekly moving average. That's your long-term bullish price. So until you get back above that price, and it's a naturally moving target, so it's going to take time and probably going to come down, that's when I'd be looking at it. But based on falling 90% from all-time highs, having this MACD curling on you, you definitely have the capability to come back down to this $40 region. It's very, very, very simple. Once you crack basically the low here of $53.69, which is only about $3 lower, you're basically probably just going to waterfall right down to the $40 region. And that's just looking from a percentage basis. That is approximately a 27% discount on from the current close share price of today.
Hey, you took away your screen.
Did it?
Okay, you're back on. Yep.
Okay. So basically, you have the monthly, which I can't even do a very good analysis of the price structure in the area. But if you just look at this monthly graph, it's just monthly lower lows. You have an engulfing candle on the month, and to me it just looks like a dead cat bounce. It came, bounced, and you could continue lower down to 0 possibly, or down to the $1 region, $15. It's just, do you want to fight for your money? That's basically the question that everyone has to ask themselves when trying to buy this company. Do you want to fight for your money? If you look at what looks Algo's telling me is like, yeah, you have a reversal zone sitting at this $50 region, but that doesn't necessarily mean it's going to stop there. RSI is bearish. MACD is it's trying to show some structure here, but it's basically coming down lower. And yes, you're in a price zone, but I cannot come to grips with having a company lose 90% and me be bullish on it. Everyone has their own way of investing. For me, I don't want to work hard for my money. I want my money to work for me. And trying to run myself in knots, and there's only the term I can use for that, to justify this company going bullish when there is 0 signs on the chart that it's going bullish, with more potential to the downside, with no price structure. You're getting near all-time lows. I just don't have an appetite for that. Everyone else there's people out there that make money on these type of companies and plays. Good for them. I don't have the time to do that, the want or the desire. So just for me, it's just very bearish. If you really want to pick it up, maybe at $15 would be a good buy. Maybe at this region down here at $40 would be an interesting starting the opportunity, maybe, because at $40, then if it drops below, let's say the $30 region, you're only taking a slight haircut, but you're not losing your shirt, your pants, the house, the car, and everything. You're just taking a small loss. You need proper risk management. But up here, it's just, I don't see any enticing value. I don't see any enticing value just to begin with the company. So I do have a bias in that I'm leaning more bearish and kind of leading people away from it. But it's just, there's so much better options out there than the S&P is going to return you 14% on average, or 10% on average over the course of multiple decades. Roku probably does not have the ability to go back to all-time highs in the next decade, just because you're going to be bouncing through all that price structure that you had formed here. Every single one of these highs is an area of selling, so you have to beat your head through all these highs. You see how I'm talking and it still keeps going? You have to spend the next probably 2 decades beating your head through all these highs. I have no desire whatsoever to do that. And I know I'm beating a dead horse with that, but guys, just stop forcing investments. Find something that's actually like to its value and that the calculator actually works, because like, what were everyone saying at $450? What were they saying at $490? To the moon? Yeah, to the graveyard, baby.
Yeah. And by the way, that does not mean that it can't go up there, but we have to separate what is possible compared to what is probable. And right now, sure, is it possible for it to go up there? Yeah, I mean, it's also possible for a meteor to fall on Earth tomorrow, right? But the probability of that happening is slim to none. The probability of Roku going back up there again is also probably roughly the same. So again, you really have to separate the possible from the probable. So that's just essentially what Roku is. So hopefully this video helped. If you guys liked, of course, subscribe, comment, really does help here with the algorithm on YouTube, guys, as well as on Rumble. And yeah, if you guys, that is the best way that you guys can help us overall. Every single earnings report that you guys saw today will be linked in the description of every single video for that you guys are going to see throughout the day. And all the calculators are always available for everybody to have. And in fact, I'm actually going to make an announcement right now, guys. I'm actually contracting, I can't believe I'm saying that. I'm contracting a friend that knows how to code within like Google spreadsheet and like macros and that stuff to automate the stupid calculator, because I'm sick and tired of going into every single company, copying the net income, copying the cash. I could make a mistake. I could miss something. I'm done with that. I hired him. Well, I contracted him, and he told me he would do it. So maybe not tomorrow, but maybe on the next live stream that we do. Depends on whether or not we want to do more live streams. But I mean, we will do live streams. I'm saying for earnings. You guys might actually see an automated discounted free cash flow calculator, and yes, when that happens, I will give it to you guys for free as well. So I will tell everybody like how to get it and all that stuff, or at least I'll try to. So yeah, that's pretty much what we're gonna have for today, guys. And again, thank you so much for watching. We really do appreciate it overall, and come back tomorrow when we reach, or when we get, a lot of companies that I'm actually really interested in. We got Amazon, Intel, Caterpillar, Eli Lilly, Valero, Southwest, MasterCard, we have to cover Crocs.
That's your favorite.
We have to freaking cover Crocs. AbbVie, Merck, Amgen. So I really want to cover all of, I don't know if we're going to get to all of them, but we're going to try to cover as many as possible. But yeah, guys, I think that will pretty much do
and
it
guys,
for
we
this
could
video.
cover some in the Friday stream as well. So basically, if we don't get it to, because there's not a huge amount on Friday, we could cover some of those on Friday as well.
Yeah, so I think that'll pretty much do it for this video, buddy. So see you all on Thursday.